Bank earnings season getting underway this morning. Results from JPM and Bank of New York Mellon. Leslie Picker's here with some key takeaways. Morning, LP.
Good morning, Carl. You saw there that JPMorgan shares down about 3% after reporting earnings this morning. BNY currently hovering around the flat line. JPMorgan's quarter complicated by the purchase of Apple's credit card portfolio, impacting EPS due to a multi-billion-dollar reserve build. Excluding that, the top and bottom lines were higher year over year thanks to a jump in its markets division, particularly equities products. Investment banking fees declined in the quarter and missed estimates in the company's own guidance thanks to lower than expected revenue in equity and debt underwriting. JPMorgan reiterated guidance on expenses, which it expects to still be about $105 billion this year, and the firm said net interest income would be $103 billion in 2026. That's higher than the street was expecting. We got a bit of color from JPMorgan executives as well on the administration's credit card interest rate cap idea. CFO Jeremy Barnum said on the media call that such a move, if it were to happen, would be, quote, very, very negative for consumers because price caps would result in the removal of credit. Chairman and CEO Jamie Dimon also responding to a question about the DOJ subpoena of Fed Chair Jay Powell. Dimon said anything that chips away at Fed independence is, quote, probably not a great idea, and it will have the, quote, reverse consequences. Dimon added that it will raise inflation expectations and increase rates over time. BNY updating guidance on an efficiency metric, return on tangible common equity, raising it 500 basis points to as much as 28%. BNY also bumping up its pre-tax margin targets. The firm beat on top and bottom lines for the fourth quarter and reported a record year in revenue and net income. And that call beginning in about 40 minutes or so from now. Guys?
Leslie, not uncommon to see JPMorgan shares down after earnings, only, of course, to then climb during the remainder of whatever quarter we're in. Typically. But was there anything in particular you think that is giving investors some pause here?
Yeah, I was kind of surprised by the move toward the end of the call there. It may have been some commentary surrounding loan growth and any expectations of 2 rate cuts potentially this year, which is what they've baked into their guidance, whether that will result in more loan growth. And they kind of gave a mixed reaction to that, saying, you know, that may not necessarily be the key driver. There are various puts and takes with regard to loan growth expectations. One of the biggest drivers of their loan growth, of course, has been both credit cards as well as NDFI loans. Those are those essentially loans to private equity funds or private credit funds, non-bank financial institutions and the like. And so all of those have kind of different, puts and takes as it pertains to loan demand than just overall, what we may have been used to historically.